My name's Austin Williams. I'm a wealth coach here at Better Wealth, and today we're going to be looking at the guaranteed versus the non-guaranteed values that you've seen on your illustration. I've had some clients in the past who've been confused about these or who might even feel like it's underhanded or something to look at one and not look at the other. And I just want to spend some time talking about what they mean and just kind of maybe dispelling some myths about either one. It's just that way you can be fully prepared and fully informed before you go down the route of pursuing life insurance. So what's the guaranteed values? What's the non-guaranteed values? We're going to look at that today. So how is the guaranteed side calculated? So in an illustration, you're going to see that there's going to be a guaranteed part of the ledger, and then there's going to be a non-guaranteed. And the guaranteed side actually means kind of like what it sounds like, is that it's a minimum contractual obligation that the carrier has to you. And what is the guaranteed situation? Is that actually the guaranteed is kind of like the floor of a whole life policy, is that it's the absolute worst case scenario. So what's the worst case scenario? So there's a few different things that determine, what the interest rate is that is going to grow the cash value of your policy. And one of those things is mortality experience. So it's assuming the highest possible mortality experience that the carrier reasonably can. It's also assuming maximum expense charges, even if it's higher than the carrier has ever charged in the past. It's still assuming like a maximum value there. And then also its general investment fund growth is minimal, so it assumes no dividends get awarded. So this is absolutely bare minimum, rock bottom growth for the policy. But at bare minimum, this is what it will grow to. So at the minimum contractual interest rate, generally most carriers, it's going to be around 3% over the life of the policy. And that guaranteed rate is set so that at endowment, the cash value and death benefit are equal to one another. So generally about 3% amongst most of the carriers that we work with. Each carrier could look slightly different in the illustration, but for this one, it's right there in the middle. It says guaranteed. They all look sort of similar in that way. And there's a cash value of the death benefit. And both of those numbers are getting calculated based upon this minimum amount of growth, such as that by age 121, both of those values of cash value and death benefit will be the same number. Now, this is a rock bottom number. And, at the very least, you have this to sleep with. Now, we don't spend much time here at Better Wealth going over the guaranteed numbers because, 3%, it's just not a lot to write home about, right? Most people don't go to bed getting really excited about 3% when inflation very well may be higher than that, on an annual basis. So, we spend most of our time looking at the non-guaranteed side of the ledger because the non-guaranteed side doesn't assume the worst case scenario. It assumes more of an average scenario, and it also assumes that dividends are going to get awarded. Now, how is the non-guaranteed side calculated? It's a great question. So it's based on current assumptions. So not worst case scenario, which realistically for the carriers that we work with, there's not only not a year in which the worst case scenario has ever happened, and I'll get to why in a little bit. This is more of the non-guaranteed side is the average scenario. So it's current mortality experience. So an average amount of people are dying every year as part of the policy owner. It has an average amount of expense charges, whatnot. There is current general investment fund growth, which means that the dividends get paid. All of the life insurance carriers that we work with have paid dividends for over 100 years without missing a single year. So the guaranteed side, well, it's good, and it's good to kind of know what your contractual minimums are. It's not very realistic because that situation hasn't happened for at least 100 years with all the carriers that we work with. And for some carriers, it hasn't happened in like 178 years. Now, it illustrates the current declared dividend interest rate, and most of the carriers that we work with, so it's going to be that contractual minimum, which is 3%, and it's, plus the dividend. And those two numbers, that the 3% plus the dividend is going to equal something in the neighborhood of 5 to 6%, something in the 6% range. And so that is going to be on the other side, right? The non-guaranteed side. The non-guaranteed side, it's not the worst case scenario. You're getting the dividend. And we like to say that the dividends are not guaranteed, but they are certainly assumed. So what starts small gets larger over time. There's a lot that goes into what the dividend is, your persistency, how long your policy has been active, the base to PUA ratio, also the time of the year that you contribute your PUAs in. If they're in the policy for longer, you'll get more dividend. There's a lot that goes into that, but the non-guaranteed side is assuming that. And so we spend more of our time looking at the non-guaranteed side of the ledger. So what's the upshot of all this? We spend more of our time using these numbers from non-guaranteed side of the ledger because they're more likely to happen. All the carriers that we're appointed with have paid dividends for at least 100 years without missing a single year. Like I said, some up to 178 years. We like to say the dividends aren't guaranteed, but they are certainly assumed. And these carriers, they have been through some objectively scary times in American history, and they've still paid out dividends every year. Some of these are old enough that they've been through the Civil War. They've been through, World War I. They've been through the Great Depression, World War II. They've been through the Cold War. They've been through Vietnam, the dot-com bust. They've been through the COVID-19. They've been through some scary times. Like Hitler was in his blitzkrieg in Europe, possibly going to take over the world. And all of the carriers that we work with still paid out dividends that year. And once again, objectively scary times in human history. So for that reason, we feel like even though it's not guaranteed, these have such a long track record of paying dividends that it's reasonable to look at those numbers and say, this is more than likely going to happen than not. So that's a quick breakdown of the guaranteed versus the non-guaranteed. Thank you for watching our content, and I look forward to your comments below.
If you're a high-earning professional, entrepreneur, or just somebody who wants more control of their money, we offer something called a clarity call. It's a one-on-one conversation where we look at whether or not overfunded whole life insurance could help you build a safe, liquid, and tax-advantaged foundation to help you grow your wealth. Now, there's no pressure or fluff. We're just looking to get real clarity on whether or not this strategy aligns with your goals. So click the link in the description below or hit the tag comment